So in today's lecture, we're going to be exploring one of the most powerful, intermarket relationship in trading. So the correlation between the US dollar index, DXY, and XAUUSD gold spot, right? Now, understanding this relationship across multiple time frames allows traders to move beyond isolated, chart trading and begin interpreting market structure through intermarket synchronization. Okay, so we're gonna go with the foundation inverse relationship. So the core principle in this between these two is this. Traditionally, whenever the DXY, which is the dollar index, is strong, we expect gold to be what? To be weak. And whenever the gold is weak, we expect the dollar index to be what? To be strong. Meaning that when the dollar index is pushing higher, gold is supposed to be going lower. Okay. So why does this often happens? This happens because gold is denominated in dollars. So when the dollar rises, gold becomes more expensive. And when especially for foreign buyers, so when this happens, it reduces demand. Okay, demand in terms of the business part of it, not the supply and demand we're talking about here, as much as they pretty much mean the same thing, right? So when the dollar weakens, gold often attracts capital as an alternative, stock value. Okay, so when we when we take a look at the macro time frame, for example, monthly, weekly time reversals, structural correlation. Um, when you go to that, you'll find that the federal when you go, you'll find that the federal reserve cycles um, is one of the key factors that you always need to put observation onto. Apart from that, you need to put an observation on yield, like real yields, inflation expectations, now risk of capitals. So, for example, what I mean here is, if weekly DXY is bullish and has broken structure, I don't know if I can. Let me see if I can get. Although I wouldn't like to mess up my chart. Okay, let's see. So in weekly, if the DXY breaks a bullish structure, for example, high highs forms on DXY, and liquidity expands into dollar assets, and weekly gold support may always fail. And this creates a long duration bearish pressure on XAUUSD. Remember, I'm talking about weekly time frame on DXY. Now, here's the rule: higher time frame on DXY, that's the dollar index, will lead to lower time frame gold behavior. Higher time frame on DXY will lead to, some people, or me back then when I did not understood well how to correlate or to trade DXY and gold properly. I would expect now, if we have a bearish candle right here on DXY, I'm expecting automatically gold to do what? To have a bullish one. It doesn't work like that. It doesn't work like that. If you take a look at these candles, at these charts right now, you'll realize that it's not that obvious. And this is the reason. This is the rule. Higher time frame on dollar index, which is the DXY, leads to lower time frame gold behavior. So if you understand this concept, then it will be way easier to know how to. And just as I've said, when higher highs on DXY, on, for example, weekly time frame, and we have liquidity expanding into dollar assets. Now, weekly gold support may fail. So, for example, right here, what I'm seeing on DXY, I'm seeing DXY pushing higher. What you're seeing down here, this is just a retracement to fill this gap. We had a fair value gap right here. This was just, and we also have an inversion. So the way we respected this period right here, I'm expecting dollar to do what? To push higher. Now, me saying this, what do you expect is going to happen to gold? Gold is going to drop. Because when the dollar is going higher, gold is supposed to what? Gold is supposed to be dropping. When we move further into the intermediate, time frame, for example, the daily candle or the hourly candle, when we move into that intermediate time frames. Okay, so now this is where the directional bias is refined. So for example, you need to study how DXY is approaching PD arrays while gold, also is approaching PDRs. For example, people trade, retail concept like, supply and demand. You need to be approaching, you need to be studying how DXY is going to be approaching supply, while gold sit on what? On demand. You see those two correlation issues, supply and demand. Okay. Unfortunately, I don't trade those type of concept. I'd rather go with with the premium and discount, PD raise, and so on. So I'll be looking how does gold or how does DXY approach PD raise, just the same way I've shown you on this weekly time frame. I'm gonna be looking like, okay, how does DXY approach this PD array right here? We have a PD array, and this PD array is on a discount level. It is a bullish fair value gap, right? So I'm going to be paying attention to how DXY approaches this one. I'm going to be taking into consideration how does gold does the opposite of this. I'm going in this scenario. I'm expecting gold to be approaching something to do with. I wish I could open for you guys gold here. Unfortunately, I wouldn't like to open this because this I have a lot of drawings in there that I don't want to mess. Maybe let us try capital.com here. I hope I don't have any drawings here. Then we're gonna go into weekly time frame for so that I can be able to elaborate what exactly I'm talking about right here. Come on, that's it. There we go. So for example, as you can see here, this is weekly time frame on DXY. This is weekly time frame on gold. On gold, we had a bearish PDRA. You guys can see it. This one here, this bearish gap, right? Supporting sales. On the other hand, DXY, we had a bullish PDRA on weekly time frame. You see, so far DXY has already, reacted well on it. And remember what I said, DXY has to react fast, then gold follows. If you try to trade, put gold first, then you like you're not getting the point. Okay. So when DXY is approaching, for example, discount level, and gold is approaching premium levels, hope you guys are getting what I'm talking about here. Now, apart from that, we have, concept of DXY, breaking through, market structure while gold sweeps liquidity. So in this scenario, DXY, do you have a break of structure right here? Yeah, we would pretty much say that we have a break of structure to the downside. But now the question is, somebody will say we have a break of structure of DXY, meaning that it's going low, but that is reading price incorrectly. Yes, we have a break of structure, but our first PDRA, our first target is right here. So once this one has been filled and we see prices respecting it, we don't expect this break of structure to hold. So we have a break of structure. On the other hand, gold doesn't have a break of structure. Gold just had some, liquidity sweeps. Just took some liquidity up here on this previous, for example, this week's highs. We took some liquidity right there. As much as we haven't really, tapped some liquidity in here, I would really love to see this gap really fail, but I really don't think that's really going to happen. It seems like gold is just going to push lower. Okay, but that is not in correlation with what's happening with the DXY. So we also have divergence between the two. So for example, when DXY makes a new high, gold does not make a new low. Are you guys getting that? When DXY, for example, DXY just made a new low, but what does gold do? Gold should not make a new high. We have a new low here. Gold is not supposed to make a what? A new high. And as you can see, gold never made a new high. Let me repeat it again. The divergence signal or correlation is supposed to be when DXY makes a new high, for example, let's use this one, a new high right here. Okay, this is a new high. Okay, gold does not make a new low. Let us take a look. Did gold make a new low? Yeah, we have a new low right here. So meaning that we still do not have divergence in here. We still do not have divergence. But pretty much I think this was divergence. You see this high. This is on Monday, 26th January. We had a high. Let's see if that 26th January we had around the same time frame. Yes. Let's see 26th January. 26th January, pretty much, yeah, here we go. We had a low. Okay, we had a low there. We created a low on DXY. and we created a high, all-time highs on gold. You see that? So this can indicate that weakening inversion correlation is possible, gold reversal. Okay. So this is always an intermarket divergence, right? So when you go to execution time frame, for example, hourly, 15 minutes, 5 minutes time frame. Now you use DXY as confirmation. For example, now let us go. For example, let's go to hourly time frame. I'm gonna go to hourly. That's on DXY. Let us go to also to hourly on gold. Perfect. Let's go on hourly on gold. Good. So if gold is approaching a bullish setup, first of all, what we need to confirm, for example, if we want to gold to push higher, we're gonna be looking for liquidity sweeps of Asian lows. We're gonna be taking a look at a DXY, rejection of intraday resistance, not liquidity of Asian. The same thing. Like, don't expect when gold is taking Asian lows, DXY is going to be taking the same thing Asian. That's going to be too obvious, and that would make trading so easy. So these guys, like, it can't happen like that. So when the XY rejects, for example, an intraday, level or point of interest, and on the other hand, we have gold taking liquidity, and also we have something like DXY having a bearish displacement, beginning, then gold received a bullish displacement. Then that is alignment that increases probability. So for example, let's assume okay, let me go with this. So, for example, let's assume I want to buy gold. Okay, I want to buy gold from this PD right here. So I'm looking for signal. So at around 14 p.m. Remember, I'm using UTC plus 3. From 14 p.m. I have a displacement of gold to the upside. So I expect DXY to give me a bearish displacement. So let us see around 14 p.m. Here we go. It's 14. We had it. You see it? We had that bearish displacement. So DXY is displaced below, but what does gold do? It displays above, meaning that this is a good correlation and this is a good alignment that increases probability. Okay. Now, final top-down correlation model. You need to use three-layer model. For example, layer one is going to be bias. Bias, we're going to start with what? Weekly time frame. Ask, is dollar expanding or contracting? Okay. In other terms, is dollar under manipulation or it is displacing or it is distributing? Okay. This will set gold macro bias. In this scenario, let us take a look at weekly profile of the of the of the of the DXY, right? So once once you analyze and realize that, for example, the dollar is expanding. So for example, this area was just accumulation, then we have this expansion. So this is just a retest of that expansion. So we expect price to push high to continue that expansion. So this will set stage for dollar. Okay. And now that will be dollar on macro bias. Now after this, we move into 4-hour time frame, or maybe even daily. I'd prefer daily. I like daily more than 4-hour. By the I never like the 4-hour chart for some reason. And it's crazy. So on the 4-hour, we're gonna ask ourselves this question: are both markets respecting inverse structure? If yes, correlation is active. If not, we don't have correlation there. So for example, on daily time frame, let me also put gold on daily time frame. So we're gonna be looking at this in this manner. We had on gold, we had some push to the upside, a little bit pushed. No, sorry, this DXY, a little bit pushed to the upside, coming from balancing this PDA right here. And let us see on gold. On gold, what do we have? We have gold also after balancing some. This was a breakaway gap, balancing PDA right there. It's also doing what? So yes, we have correlation. The only thing we're missing here is that we don't have a bullish gap. We don't have displacement both on DXY and gold, which also part of correlation. If gold was giving us displacement, then DXY does not have displacement, meaning that we don't have an active correlation. Now, layer three, now we move into lower time frames like hourly and so on. Now, use lower time frames, for entries. Now, entry only when DXY confirms goal setup. Now, this is correlation assisted execution. I'm not saying that now this is a strategy that you can use independently. You need to understand the concept of liquidity. You need to understand breakout structure. You need to understand how to do price correctly and so on. So you're just using the XY to confirm what gold is doing. For example, I've given a good example here. We had displacement during this time interval, and the same thing we had displacement with gold. So this is just a confirmation that you are in the right place. Now, if we displace in here, the first question would be if DXY is pushing down here, what's the drawn liquidity? Right here. Once we take out this liquidity, we see our price is reacting from that level. Pretty much the same thing. If we're pushing higher, what's our drawn liquidity? Definitely these highs. As you can see, we ended up creating more of relative equal highs there, which makes it quite interesting point of interest. But I also did a video about using gold and gold dollar and gold euro as SMT, divergence. They give perfect divergence. XAUUSD, XAUUR, gold euro and gold dollar. They give perfect SMT divergence. If you guys have want, like they're supposed to be moving together because they're both against what? Pretty much the same thing. So when one is creating higher highs, we expect the other one to create highs. But when one fails to create higher high, and the other one creates it, and of course you have divergence. When one takes liquidity and the other one fails, definitely, pretty much the same thing. So guys, I don't want to go deeper into this, but I'm really planning on creating a course, some serious valid course that is really going to help traders, and it's going to include time cycles. Time cycles like nobody has ever talked about. Forget about the GAN, forget about ICT. Like this is something completely different. Something that when I talk about, most of you are going to be like, "What?" Yeah, and it's not going to be on these high time frames. No, we're going to be using from 30 minutes time frame going down. So yeah, it's something. So I'm still working on it. It takes time to put all these things together. Then once it's ready, I'll let you guys know. And if somebody's interested, I'd like to see a heads up. Whoever is ready for this course, of course, it will include also the fundamentals, the correlations, and mostly I'm going to be focusing on gold. But of course, what I'm talking about is going to be happening on any asset that you want to trade. So that being said, make sure you guys to check that out and let me subscribe there, comment with a heads up. Then I'm gonna be working on it. Hope you guys enjoyed this one.